Welcome back to another episode of Raise Masters Radio. I'm your host, Pat Boltapetty, and I'm joined by a very special guest here today, Matt Sinclair. He's going to be telling you about how you can get creative with structuring your deals to kind of offset some of the drawbacks that maybe people have with developing single-family homes, things of this nature. He's had some really big wins here as of late. But before we get into that, Matt, wanted to hear more about how you got started in this. Tell us a little bit about your story.
Sure. Thanks, Patrick. I spent most of my career as an investment banker, primarily at JP Morgan. I came up in the real estate investment banking team at JPM, where I learned from and basically worked alongside the team that worked with Blackstone post-financial crisis to build out the platform that was ultimately IPO'd as Invitation Homes. So real estate's just my favorite thing. And I was so fortunate to be able to work with high quality professionals. And over the course of my career through real estate, private equity and investment banking, I've executed over $35 billion of transactions of various kinds. And it's just something I've been very fortunate. But I think my key takeaway there from all those deals across the different sectors was that build to rent presents a huge opportunity for several reasons. And it's also just my real area of interest. So alongside working on Wall Street in New York City for all those years, I started just buying single family houses as investments just out of interest on my own. And I think that my experience as a landlord has really shaped my perspective. And it's sort of more than what you might typically get from just doing things at a high level from your Wall Street job. I think being a landlord is eye-opening, and you really start to think about things like tenant quality and operating expense efficiency. And I think that really underpins kind of the business that I've built and launched now.
Okay. And what would you say? I know you said you go with the build to rent strategy. What would you say are some of the pros to that? Somebody that's maybe on the fence of, do I want to buy product that's already improved, product that's already been built, or do I want to, take on building from the ground up and then managing it after the fact?
I would say something that's really, really attractive about Class A new construction in the suburbs where we focus is just the tenant quality that you're able to get. The tenants are attracted by the quality of schools, low levels of crime, access to diversified job bases and so forth. And they're looking for stability and security for that stage in life that's sort of post multifamily. It's a stage in life that's now been elongated because home ownership is just out of reach for a lot of folks. And also people like the flexibility of renting. So you're able to attract really high quality tenants. So your duration of tenant occupancy is substantially longer than it would be for multifamily by a significant degree. And so your turn costs, which post Q1 of 2020 have really been elevated as the cost of building materials and labor just spiked, and then basically off a new base are probably tracking inflation. And so the economics of rental properties have really changed in the last 6 years.
Yeah.
I think it's to the point where right now the best value proposition in the market is new construction. I would also say the timing specifically is opportune because a lot of builders are holding supply on the credit facilities, basically incurring interest expense. And so a savvy buyer who's buying in quantity can step in, help the builders out by taking down large blocks of build-to-rent housing. And you really get your pick. You can work with best-in-class builders to really choose the houses lot by lot. And that makes a considerable difference from the tenant's perspective. And I think specifically where I've launched my business in the suburbs of Memphis, Tennessee, we're really seeing an incredibly high degree of demand for this type of product. There's a segment of the renter population that is underserved, and it's sort of at the higher end of the suburbs here. The suburbs here are also substantially underbuilt. There was just a collapse in building post-financial crisis, and it's steadily ticking up, but there's still a huge supply gap. And so if you're able to, work with builders in the right housing, you can really attract an excellent quality of tenant. And because it's new construction, your OpEx burden through at least the first 5 years, if not 10, is substantially lower than what it would be for an older vintage property. And we measure that via NOI margins. So And NOI margins that's a subject I spend a lot of time thinking about and evaluating. And when I develop
Of course.
my forecasts, I work in conjunction with an excellent property manager here that I've personally worked with for years. I have access to data going back many years, and I can break things down by different types of properties. And so from that, I was able to derive a forecast, really just seeing what types of properties tend to perform the best. And from there, really focus and zone in on Class A new construction in the suburbs.
It sounds like, and I think this is the perfect segue into, some of the breakthroughs that I know you've had with the business, but it sounds like you got to have some incredible efficiencies and relationships to really get something like this going. I know, especially at a time like this where interest rates are high, cost to build is high, you've got to have some efficiency, some steep efficiencies on the front end where you can make sense of it. And because there's not a lot of room, would you say it's kind of soft as far as like the rental market's concerned of where you can push rents right now? Like it's kind of a soft market. You can't really continue to go that route of, you know, 5 to 10% increases year over year, like we were doing in say 2018, 2019, 2020, like as we were moving forward. So I know the environment, like you said, has changed. Can you speak to some of the efficiencies that you've been able to bring to your practice, how you did that, how long that's taken, things like that?
Absolutely. So a couple things, I think really digging into asset selection from the perspective of tenant quality and lease up. So we're in the market right now with our third fund. It's built to rent fund 3. And we've actually, it's 36 houses in total, the first 13 of which we closed on September 30th. We've already leased and pre-leased 10 of the 13 houses, all at the targeted rents, if not slightly above. So we've actually been quite successful in hitting rents. We don't expect there to be really high rent growth for the foreseeable future, but we were able to achieve rents. And my point being, first and foremost, it is asset selection. There's a lot of evidence to suggest that better designed buildings, better designed housing will attract and retain tenants more effectively. So I have an architect review everything we look at, and we're able to work with really, really great builders. I think the second point I'd mention, because with the uncertainty and with elevated interest rates, risk management is really paramount. So right now, we're not taking ownership of homes until we receive certificate of occupancy. So fluctuations in building materials and labor, time delays, the typical things that can really harm new construction projects. That's not on us. It's not on our investors. That's basically risk that the builders are taking. And only once the house can be moved into basically by a renter are we technically closing on it. So that second point is risk mitigation and really just being smart about, where the risk is and what risk we're taking. So we've done a lot of work to make sure that lease up risk, which is the risk we are taking, is something that can be mitigated. We've done a lot of work to make sure that the market size for renters in a given area can absorb the amount of product we're bringing to market. And then the next point on that, we're 36 houses. It's not concentrated in one contiguous block. These are scatter site homes across 3 different suburban submarkets and 8 separate developments. So that's by design. It would be extremely difficult to lease up too many houses in just a small number of developments. So by spreading them across 3 submarkets and 8 developments, we've had a tremendous amount of success. It's measured by achieving target rents, but also lease up velocity. So, that's confirmed our thesis, and it's great to see that working. But even with that, something that I think makes us pretty unique is that we've integrated our real estate private credit business into our scatter site build to rent funds. So if you think about the typical drawbacks that one might experience with new construction, Class A, suburban, it's
Right.
low cap rates, right? These are really, really nice assets. They're highly desirable, all of sufficient quality to be primary homeowner occupied homes. That just gives us the flexibility if need be. We could sell the primary homeowners. It just gives us another option. All the homes are also in the buy boxes of the big SFR funds who are active in these specific submarkets. Again, that's by design. But the downside, like I said, with new construction, typically would be just lower cap rates, but in an environment of higher interest rates, you're going to have a pretty low yield.
Negative. Yeah.
What we've done to augment this, and I think is, again, really unique, is we're using real estate private credit. So that significantly enhances the yield on the portfolio and the IRR, but also it reduces the cash flow volatility quite a bit. And, all the loans we're making are 100% asset backed and secured, fully collateralized. So it overall is a net risk reduction from the fund. I think that is something that I think makes it a pretty unique value proposition for built to rent fund three. So for example, on Class B shares, which is the most common type of shares, the IRR over 5-year hold, we're expecting to be approximately 13.9% with a cash on cash return of about 7.4%. For Class A new construction right now, where we're not actually developing or taking on risk, I feel like that's a very, very good risk reward value proposition, asymmetrically in favor of our investors. And that's really, I think, the crux of MIP Capital Partners, which is the firm Asym and I have been building over the past couple of years. And I think, continuing down that road is prudent in an environment with this much uncertainty and again, sustained elevated interest rates.
Absolutely. I mean, it's not many times you hear of like brand new Class A funds that are producing at that level of yield. So that it's definitely something worth noting. Just for somebody out there that's listening to this and is saying, okay, it sounds like there's a lot going on. Just to, I guess, simplify it, would you say you're finding a subject property, right? You have the builder that's going to be building it. You're not taking ownership until you get the certificate of occupancy. So it's reducing the risk for you, your investors, right? Are you lending? So you're doing the construction loan to get the property built, and that's how you're generating some income to the fund in the meantime until it's built and until it starts cash flowing with tenants and occupants? Is that the structure?
So you could do that. That's not precisely what we're doing, but
Okay.
I understand that's a, lending to builders is something that I am considering doing as part of our growth strategy. But right now we raise equity from investors. We take down houses from builders, don't close until certificate of occupancy. The purchase discounts negotiating with builders are quite substantial. And that's really why this is such an opportune strategy right now, is because you're essentially able to make your money when you buy. So, we're basis oriented investors. We want to get into something for a value such that we're paying less than that value, right? As measured by various independent measures of value. And so we have these significant discounts. Now, what's unique with us in the way that I've structured the purchase discount mechanism is the discounts are effectively cash. We then have cash in the form of those discounts, and we lend that cash. And so that is through the real estate private credit business. And, it's one thing to talk about direct lending. I think it's fairly simple, but not easy. Direct lending, you really need to have a very, very savvy
Good process.
and an excellent renovation team. And so my business partners in MIP Capital Partners are the owners of a fantastic local business called Memphis Investment Properties. They've renovated over 6,000 homes over the years in the Memphis MSA. They're, I think, the number one rated turnkey company in America, top quality professionals. And so we're lending to their turnkey business. Basically, they buy homes, do a scope of work, renovate those homes, and take them to market as turnkey properties for their clients. They're an excellent business. They've identified exactly the part of the market that's the most liquid, where they have the most demand from their clients. And, MIP Capital Partners, the funds lend to Memphis Investment Properties for turnkey properties. Just for some context, our lending business has originated 828 loans since January of 2021, and there's 100% repayment rate. And those are 100% first lien position secured. And it's been working quite well. And the key thing with direct lending is the process is really simple. It really comes down to the execution of the team. These guys have decades of experience in a very specific niche. And so I'm very comfortable lending to them. I also am a very experienced underwriter. A lot of my career was spent executing leverage buyouts. And I fairly familiar with all the different mechanics of direct lending on single family construction projects as well. And so I'm thoroughly involved in the underwriting of these loans and a pretty rigorous process. And it's been quite favorable, really just because risk reward, it's tough to beat. But again, it really comes down to the team that's executing those renovations. So for our clients with MIP Capital Partners, I think it provides something pretty unique. It enhances the yield, it increases the IRR, and it also reduces cash flow volatility. I think that something that is often overlooked with single family is the volatility of cash flows if the person only owns one home or five homes or even 10. You have single tenant concentration risk. And so that's not large enough to have a portfolio effect. So we make sure that our funds are a sufficient size that the idiosyncratic risks measured by cash flow volatility of any one property are nullified via cash flows from the other properties. And so there's a sweet spot, and it depends on the market you're in. It depends on the type of property, but we're making those calculations to ensure that the volatility of cash flow is low. That's really important if you're levered and you're paying distributions. And so in our confidential information and memorandum is pretty rigorous in that I include a credit case. It's basically a downside case where it's like, well, what happens if there's a recession? What happens if OPEX goes up? What happens if you can't raise rent? I've run dozens of scenarios, and in each scenario, we are able to make our distribution payments in each and every month through our 5-year forecast period and make our debt service. And so I think that's pretty special. That's unique. You don't see a lot of deals like that, but frankly, I wouldn't ever take on a deal unless I knew that we were able to make our debt service and make our distributions to our investors in each and every month. And again, it's really the combination of the deals that we're able to make with builders, our underwriting process being very rigorous, basically back testing of thousands of data points going back several years. I have the data through our scale property management partner that we're working with. And then the final point being like the real estate private credit business is an excellent business. And I think the intertwining of the real estate private credit business with the portfolio of single family new construction homes creates something, again, pretty unique. You have recurring distributions with a reasonably high yield, but you have, arguably the safest asset class in all of real estate in high quality Class A new construction single family homes, because it's that market is ultimately backstopped by the American primary homeowner, which is actually right now incredibly healthy in terms of credit quality. And so thinking through all the different permutations that one could face as an investor and with an uncertain future, I'm very comfortable that irrespective of market conditions, we're going to be able to deliver.
It sounds like, Matt, that you and your team putting a lot of time into risk mitigation, right? It's helped you guys with raising capital. That's a fair assessment?
Absolutely. I think risk mitigation is paramount when you're in real estate. I've worked across many different sectors as an investment banker. So I got a lot of different looks at different sectors and where the pressure points are. With real estate, it's a capital intensive sector. It is illiquid and it is highly cyclical, and you're levered. So logically, it is liquidity risk that is the main risk that you got to look out for. You can't pay bills with equity, and if you think about the thing that hurts most guys in our sector, it is liquidity issues, and primarily two ways. You've got just an inability to meet short-term demands, interest expense and so forth. That's a major risk. And the other one would be when you come up against a refi period and for whatever reason, you can't get the LTV that you expected. Those two things are what get most guys in trouble in the sector. And it's unfortunate, but it's like, we keep having to learn these lessons each cycle in real estate, and, players get caught. We've been very, very careful in setting up our business and have designed our entire business plan around mitigating risks, namely liquidity. And so we have a very, very large cash reserve balance. Again, that's the basis of our ability to embark on this real estate private credit business. But our loan length is actually quite short. The amount of time that the loans are outstanding tends to be about 4 months on average. And so if we did, for example, experience a situation where we thought that economic conditions were weakening, we could simply stop lending, right? And that's a very, very good leverage to be able to pull, in an uncertain environment. If we needed to, we could just cease that lending business in terms of new originations. Because our loans aren't long in duration, we're not going to get caught. And again, having back tested through the several real estate cycles and taking a look at what occurs from an occupancy perspective when there is a downturn. A great thing about single family rentals, there's a certain degree of stickiness. People need a place to live. And that, I think, one other point that I would put, Memphis, before I chose Memphis as the target market to launch our inaugural vehicles in, I did a lot of work, just basically looking at Southeastern markets, different MSAs, studying the tendencies. I canvassed 16 different Southeastern markets in person, basically scouting out the suburbs, looking for the ideal situation. And I landed on Memphis, which to a lot of people might seem counterintuitive, but I've never seen a market with such a bifurcation between what's going on in the urban core versus the suburbs. In the suburbs of Memphis, you have elevated population growth, so quite a bit in excess of the US overall. For example, you have high quality schools, and you actually have levels of crime, violent crime and property crime that are below the national medians by quite an extent. And so you have the situation in Memphis where there's people basically moving to the suburbs. And, there's a bunch of reasons why people are doing that. A lot of it has to do with people wanting more space, more privacy. They want safety. The quality is a big one. And so we really get a high quality tenant, but we're able to get into these houses at a cap rate that's quite a bit in excess of what one would normally get for houses of this quality in these types of suburban locations. So again, in an environment with elevated interest rates, you really need to think through all these different options. And again, the market selection for us has been paramount. It would be quite difficult to do this in most markets.
Yeah, I definitely, it's because I think everybody's aware of what's going on in the real estate space and how things have slowed down, and to now get that traction and get transactions moving, people do need to get creative and come together and, actually make things work, So that makes a ton of sense. What would you say? Because what we like to do, Matt, is, for the listeners of Raise Master Radio, we like to give them something that they can use immediately. When somebody's evaluating an area, let's say like you did for Memphis, prior to launching something big, are there maybe 3 really important metrics that you stress on? And if there are, maybe 3 or 5 of them, could you list those out just so at least people have something that they can kind of target for markets that maybe they're looking at and they're considering to launch certain funds and creative offerings?
Absolutely. I've developed a 3-phase screening process, and I basically did this for a living, helping companies on mergers and acquisitions, figuring out what to buy, where to buy. It's tremendously important. The first thing would be the suburban submarket analysis. So you want to be in a place with sustained population growth. Again, it doesn't have to be outsized, but it does need to be sustained and elevated. If you look at markets that have had populations decline over time, there are, I don't want to name those markets, but it's been pretty tough on real estate. You want population growth to be positive because you're going to need to get a degree of rent growth to offset the fact that your cost base goes up over time. If you were in a situation where your population wasn't growing, you would have a difficult time growing rents, but your cost base would go up, implying that your margins in some cases could actually decay over time. So that's the first thing. You really want to make sure that you're in an area with population growth. It's probably the single most important thing.
Awesome.
Another key point, you want to be in an area with a diversified employment base. Sometimes when you look at small tertiary markets, the math on paper can look really great because you're getting in at, higher cap rates, but you could have single employer concentration risk. So if a factory leaves town, it could really put rental properties in a tough spot. You don't want to be in that position, especially if you're levered. You want to be in a market where there's a diversified employment base in commuting distance of where the given property is. So it should be diversified, not just by employer, but by sector. And then diving into the sector point, at least for the types of what we're looking for stability, our whole business is based upon that. So you want employment sources that demonstrate acyclical characteristics, meaning they're not particularly prone to economic fluctuations, that the wages are quite sticky. So there's three things. You have government, education, and healthcare, right? With healthcare, if people need healthcare to be done, if they need an operation or something, that's the kind of thing that they're going to need irrespective of economic conditions. And the people who work for in the healthcare industry, at least generally, don't experience the same degree of vulnerability in an economic downturn. And so approximately 30% of the population within Memphis is in government, education, and healthcare. And so you have a pretty robust and deep pool of potential renters with sticky, secure wages. I think another point, you want to understand that the type of market you're in, and at least for us, you have about 58% home ownership rate in Memphis versus approximately 65% nationally. And so just a proportionately higher number of people are renters. And so we have a very deep market in which to look. And again, I think, I could go on. I love this stuff, but another key point, you want to make sure that there's the ability to absorb rental properties at the specific rent price point that you're talking about. If you go in with product that's too high end, it might not be, and there might simply not be the market to absorb that many of those properties at any one time. So before you do, especially if you're buying new construction, you need to ensure that there's going to be just the capability of practically lease up the assets. And I think finally, in terms of quantitative measures, great schools ratings. So you can, look this up when Zillow includes great schools rating. Great schools is a reputable organization. I mention this because school rating tends to be a proxy for many different elements in a given area that are important for renters. So even if your tenants, they might be retirees, empty nesters, or people without families for whatever reason, it still matters what the school quality is because, again, like I said, it's a proxy for so many different things. We know that this is important because if you look at the big single family operators in America, when you look at the statistics on what they target, it's very clear that their business model is like designed around school quality. And, depending upon which single family business you're talking about, it's a bit different. You'll have the Class A players like American Homes for Rent, Invitation Homes, Progress Residential. Their great schools rating, average is about 5, which is where we're targeting, and what we have is our average school rating as well. So we've designed our portfolio to ensure that we're in the buy box of some of these bigger players so that as a potential exit, we could sell our portfolio there. But again, it's no coincidence that they're in, this certain level of school quality. And you can also see the interquartile range of their holdings fits within a tight band. And so that this is it's very interesting, but that's one of the ways that the single family ecosystem is organized, is by quality. So I'd say those are the key things to look for.
Thank you.
And again, it's important to not be compromising on those metrics. One other thing I would mention, much harder to quantify, but you want to be in an area with a degree of supply inelasticity. So you want to be in a place where, to some degree at least, it is challenging to add new supply. Sometimes that's because of geography. A coastal market, obviously, there's just a limited ability to grow. In other areas, like in Memphis, ironically, zoning and permitting and sewer capacity constraints are themselves quite a driver of inelasticity of supply. And so it can make it difficult to build, but at the same time, it protects us to a degree from there being a large inflow of supply. That's absolute paramount importance. Is you want to be in an area where you're not going to get inundated with a huge amount of supply. Like, there are certain markets that have excellent growth characteristics, demographics, cities of the future, but it's so easy to build in those areas that everything could be fine. And, 2 years later, you're having difficulty occupying your homes because there's just been this deluge of supply. And so you need to be careful and ensure that you're in a market where, to at least some extent, there is a degree of inelasticity of the amount of supply that could come online in any given period.
Those are spot on, Matt, as far as like what people need to know. I mean, thank you for sharing that. That is just huge information. And I wanted to ask you here, obviously being a part of Raise Masters, what would you say has been, you know, one of the big things that you learned there that you've kind of kept, throughout this journey?
I think that it's a very valuable community of like-minded people who are, in it to help each other. So I think the single biggest thing is probably the relationships that I've made with all the, very interesting and motivated professionals, again, of like mind. And so being able to talk shop with these different people on different things that have worked is enormous, because it shortens the learning curve. If I had to go and learn for myself every possible way to go raise capital, it would be infeasible from a timing perspective. You can shorten the learning curve and get right to what works via the right network and talking to the right people. So I think for me, it's been the network itself. I found the course is obviously very helpful as well, but I think it's the network that really has been illuminating.
Awesome. Awesome. Well, Matt, we really appreciate you stopping by and, sharing these insights. I mean, what you guys are doing at Capital Partners is fantastic. I think the structure, especially with what's going on, in the capital markets in the day and age that we're living in, it's neat to see the creativity that you guys are operating with. Is there any like final marks you'd like to leave the audience with?
I would say stick to your convictions. And so for us, that means we're uncompromising on the standards when we're evaluating acquisitions. We don't do deals just to do them. We have a very, very rigorous process, and we stick to our guns. And I would say that's got to be that if you're raising money, you really need conviction in what you're doing, but you also need to not get swayed, not accidentally make a bad deal just for the sake of it. We really, really dig in and ensure, if it's not the right deal, then we'd rather not do it. And I think especially in the current environment, that's got to be the way to approach this.
Thank you, Matt. Thank you for all the insights here today. All right, everyone. That wraps up today's episode of Raise Masters Radio. If you got value from this conversation, share it with someone who's raising capital the right way. I'm your host, Pat Voltapetti. Stay sharp, stay intentional, and keep raising with purpose. I'll see you on the next one.